The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A bet on the economy or a bet on the Fed? Live from Studio 2 here at Bloomberg headquarters in New York, I'm Romaine Boston.
And I'm Scarlett Fu. We're kicking off to the closing bell here in the U.S., a fire hose of data to sift through today.
Absolutely.
All right, well, let's take a look at where markets stand right now. Stocks opened lower but turned positive in the late morning, really have not looked back. The S&P 500 currently up 1/3% right now. And this is without the help of big tech. The Mag 7, as you can see, down 1% as a group, more than 1%. That's the first decline in about 6 days' time. The real action, though, across the markets is in the yield space. Bond yields are sharply lower here. You can see the 2-year coming down almost 8 basis points, the 10-year down 8 basis points, thanks to a coolish wholesale inflation report and also weaker retail sales.
59.12 right now, Scarlett, on the S&P 500. Quite astonishing given where we were just a few weeks ago. And really hard to believe that a month ago, U.S. equities were actually deeply oversold. Yet today, they're cracking into overbought territory, a technical testament to that dramatic snapback in sentiment over the past 5 weeks, as a lot of folks got a sense that the trade war might not be as painful as thought. The Atlanta Fed's running estimate of real GDP growth for this quarter, that's actually back up to 2.3% now after being as low as 1.1% just 2 weeks ago. But as Jamie Dimon said earlier today, we're not quite out of the woods.
I'm going to defer to economists who give it about a 50% chance. I think all these things are probably inflationary a little bit more and slowing down the economy. If there's a recession, I don't know how big it'll be or how long it'll last. Hopefully we'll avoid it, but I wouldn't take it off the table at this point.
And really, the crystal ball remains cloudy for everyone out there, and today really showed why. You had multiple economic data points sending multiple and conflicting signals. U.S. factory production declining for the first time in 6 months, but weekly jobless claims remained unchanged. Retail sales growth, that slowed as consumers cut back on cars and sporting goods. However, wholesale price inflation, that unexpectedly declined by the most in 5 years. But if the economic data is unclear, the commentary from C-suite executives, that's a bit more blunt. Walmart, which has aggressively cultivated a reputation as the value-oriented retail stock, said it can't hold the line much longer on absorbing those tariff-related cost increases and may have no choice but to start raising prices for shoppers as soon as this month, Scarlett.
Yeah, and that's something else for investors to sift through as they go through all that mixed data as well. So they're now dealing with signs that the growthy part of the market is overbought. This is something you referenced. Take a look at this chart. The white line is the S&P 500. The NASDAQ 100 is the blue line. And less than 1 month ago, you saw the NASDAQ, the NDX, sitting at a 1-year low and technically oversold. That is below the green line there. Since then, it has surged 25% and entered overbought territory, which is marked by the red line. The S&P 500, that white line, just on the cusp of entering overbought territory as well. Now, this is a contrarian indicator, which means being overbought simply makes it more vulnerable to a pullback. But as you can see from last year, the index can stay overbought for a while before seeing a sustained downturn. Romaine?
All right, as we kick you off to the close here on this Thursday afternoon, we want to bring Scott Chronert into the conversation, U.S. equity strategist and global head of ETF research over at Citi. And I know that a big part of the rally, Scott, that we've seen over the past few weeks has been a little bit more technical in nature. But I am curious if there is a fundamental case to be made for a continuation of this rally, in your view.
Oh, I think there definitely is a fundamental case. It's just going to take some time to play out. I think the chart that Scarlett just showed is sort of mission critical on this. So there is a fundamental element to this. Back, as we're coming off of Liberation Day and then on the heels of Moratorium Day after it, you were still looking at a circumstance where the earnings trajectory and fundamental profile for the S&P and broader U.S. equity markets was clearly in jeopardy as a function of materially higher tariffs. Now, we've walked back from that cliff, as you will, to something that's less onerous, but it's still not clear. A 10% effective tariff rate, just factoring that in as a baseline case, still creates a headwind for fundamentals for the S&P 500. And as you go into the ongoing budget negotiations, signs of economic slowing, as you're already pointing to, I think we have to allow that there's an opportunity for the S&P to digest some of the recent gains.
I am curious, though, too. I mean, it's curious that you bring up the tax bill, because I know a lot of folks in Congress, on Wall Street, have been waiting to see a little bit more progress when it comes to some of these fiscal proposals, whether it's dealing with the budget deficit or these tax cuts, et cetera. If we do get a little bit more clarity on that and Congress is able to move this forward, and presuming that the tariff trade war doesn't heat back up to the extremes that it was just a few weeks ago, Is that going to be enough to sort of placate investors in the meantime, or are they still, do you think, maybe going to be sitting on the sidelines?
I think the storyline very quickly, even though we're mid-May, the storyline is going to quickly move to how much of an earnings snapback can you get in 2026. Now, right now, we're projecting earnings growth for next year somewhere in the low teens, 13, 14%, not too far off of where consensus goes. So the discussion point around all of this is that we've been to the precipice on tariffs. We've walked back. We're still navigating where we go with the budget process and where that takes the deficit math. But all told, what the opportunity for equities here is that as you turn the mid-year corner, begin to go through the back half, eyes usually pivot to the out year, right? And so if we're able to look at a fundamental and economic valley right now that leads to growth coming out the other side, yes, that's where you get more constructive on U.S. equities. That's what's more or less reflected in our bull case, not our base case, but a bit premature to go down that path just yet.
Okay, if that's what you believe, that you could get more constructive in the second half, where do you park your money in the meantime until we get evidence that that second half recovery will start to materialize?
Yeah, so going into Q2, we went down the growth is defensive path, went overweight tech, married it with an overweight in communication services. And then on the heels of the Liberation Day and then Moratorium Day levels, we came in and said, look at from these points, we want to be a buyer of U.S. equities. We want to focus on growth. And the whole angle here was that the fundamentals for the mega cap growth part of the market remained pretty intact. Valuations had corrected pretty significantly as that part of the market drew down the most to your oversold indicators that you were looking at earlier, Scarlett. And so what the setup was, in our view, and still is for that matter, is that we've got the best visibility of persistence of growth in that part of the market. We've alleviated some of the shorter term concerns. Yes, we've gotten aggressively priced probably in a very short term basis, but we still think fundamentally this is the best place to be. Now, for context, that growth part of the market came through Q1 earnings with essentially no change in 2025 estimates. The same cannot be said for the cyclical and defensive parts of the market where we're still probing for an earnings expectation bottom for 2025.
Okay, so growth is back to being a defensive play, and I guess Mag 7 as well, although the two are often the same thing. Which kinds of growth companies are the most all-weather, given that there's still so much up in the air right now?
So all-weather probably is best defined by the software component. That part of the market is probably less exposed to tariffs on a first-order effect. Maybe you get caught up in second-order, broader macro concerns. But I would say the software side, the internet and media space right behind it, probably in that pole position on that. Now, where it gets interesting is as you back off on some of the China angst, semiconductors come back into play. And we've been overweight semis going into this year. And there you had the more significant valuation setback into the, let's call it the tariff and Liberation Day, post-Liberation Day lows. So you have more snapback opportunities still. Now, that's playing out pretty quickly, but I do think that play is there. And then the last part of this is switching over to consumer discretionary. Consumer discretionary has been sort of front and center of where tariff impacts are going to show up most directly and most aggressively. So as you begin to peel back the worst case for tariffs, you come back to that sector. And then you've got names like Amazon, which have been caught up in that sell-off that presumably have room back the other side.
I'm curious too, Scott, when we talk about the complexion of this rally that we've seen, this idea that so much of the buying has been driven by retail investors, at least if you believe some of the proprietary data coming out of various banks here. We talk about 22 straight weeks where we have seen individual investors as net buyers. Meanwhile, you've had something like, 16 of the past 22 weeks. We've seen the institutional side be net sellers. What brings the institutions back into this market?
I think it's the price action is what begins to bring you back. And we caught this in our ETF flow work, Romaine, where we've seen over the past couple of months the flows into your broader U.S. into index ETFs has been very persistent. And that's where the financial advisor retail community kind of lives. Now, the institutional world, whether it's long only or long short, is living in a much more real-time performance backdrop where I think they've been, kind of caught into the tariff discussion. So I think what we're looking at right now is on the heels of moratorium day and then this most recent news on the China push out is that you're now snapping back into this risk on mode that's causing some short covering, some repositioning, all of which has spurred the index up to where we are currently to these shorter term overbought levels. So I don't discount any of this. This is all important in terms of where we are in sort of the risk backdrop. But I'd say all told, you're starting to see that money come back. But what it's going to need is more fundamental confirmation to keep it persistent. That's a missing link right now.
All right, Scott, always appreciate you taking time for us. Scott Chronert, U.S. equity strategist and global head of ETF research over at Citi on this Thursday afternoon with the S&P holding in the green, the NASDAQ flipping back into the red, and a big conversation coming up in just a second with the chairman of PGIM, David Hunt, speculating, or I should say reflecting, excuse me, on a 14-year career as head of PGIM and giving us his insights here on the recent pause in investments and the need for more clarity and a tamp down in volatility to bring more folks back into this market.
Plus, there is still hope. Morgan Stanley's chief economic strategist believes that even with this fog of uncertainty, there's still a window for the Fed to cut rates this year. Ellen Zentner, the one and only, joins us with her outlook.
And all eyes on emerging markets. Greylock President Hans Hume's going to be joining us to talk about how tariffs and geopolitics are hitting the world of developing markets. All that and more coming up in just a second, right here on The Close. This is Bloomberg.
Next week, Bloomberg brings you live coverage from the Qatar Economic Forum. Bloomberg Horizons Middle East and Africa and The Pulse will be broadcasting live from the conference floor. Then, throughout the day, we'll bring you all the highlights from the key policymakers and market movers on the issues confronting the global economy. Live coverage from the 5th edition of the Qatar Economic Forum starts Monday, right here on Bloomberg Television. Context changes everything.
Volatility has come way down this month, but the big swings we saw in prices last month continue to haunt investors and executives alike. PGIM Chairman David Hunt, who just stepped down as president and CEO of the asset management firm, says clients are looking for clarity and they are very much in a, quote, pause period. Here's part of our conversation from earlier today.
I will say that the tone is absolutely more guarded, more difficult, and many clients are really putting allocations that they had planned on pause for the moment until there's more clarity. So we, came into the year where there's quite a lot of optimism, I would say. People really felt that U.S. exceptionalism was carrying on. They felt pretty good about the economy. The proportion of people who felt we were headed for a recession had fallen a lot. And what a shift in just a couple of months, and particularly in that first 10 days of April. So I would characterize our clients as they're pausing. They want to wait and see. They aren't taking action, so we don't see people selling. But they are not carrying on with the overweight they had in the U.S. The way that they were even 4 months ago. And they have absolutely paused on some of the risk assets that were coming back, like real estate. So we're in a pause period.
A pause period. What gets us out of that pause? Is this really just all about a tamp down in trade tensions, or is there more to it?
No, there's more to it than that. I think that people are all of a sudden fundamentally reassessing the allocations that they've had. So our clients over the last couple of years have had an over-allocation to the U.S., and they were nervous about it, but ultimately didn't see what a viable alternative was, and so kind of got themselves comfortable with it. I think they are rethinking that. They are thinking maybe we go back to our long-term averages. There's still, many of them are 5-8% above where they were. And maybe actually they want to go back to that, which will largely be done by new allocations, I think, rather than selling existing. But you are seeing people think it's not just tariffs. We don't really know what tax policy will be here and what actually fundamentally does get through the administration. So there's a lot of unknowns that I think people feel that just uncertainty is at a much higher level. The risk premium is higher, and therefore they're going to demand a higher return.
So animal spirits have certainly been muted.
Yeah.
Talk about the long-term changes that your industry has faced as you close out your tenure at PGIM. I mean, what have you put in place to position PGIM for the gold rush that we're seeing into private assets, especially at the retail level and at the wealth management level?
Sure. So I think that the biggest change over the decade has been that the world used to be divided into two. There was the kind of long-only managers that did stocks and bonds, and then there was the private equity guys who did privates, and increasingly they expanded beyond kind of private equity into private credit and into real estate. Those are coming together. There really is not two distinct ecosystems. There's not two distinct groups of clients that just want to talk about privates, publics. It's all coming together. And I think what I have tried to do at PGIM is actually to dramatically build out our private alternatives capability, because I really saw the fact that these were coming together. Our clients want to deal with large global players who offer privates and publics together and can create solutions out of it.
Part of our conversation that we had with PGIM Chairman David Hunt, of course, just stepping down as a CEO of the asset management firm at the start of this month, Scarlett. And it was kind of interesting to kind of bookend his career, because I'm told that the very first interview that you did with him was back 11 years ago, right?
Yeah, that's right. It was when we went to Milken, I believe, and it was his first big TV interview. So I guess he wanted to bring it full circle. Yeah.
All right. Well, cool. It was very nice, and I was just a wonderful man. And of course, we'll keep tabs on where he goes next. When we come back, we're going to refocus
He said no golf, though.
I know that kind of annoyed me. Though. He said he's a tennis guy. Anyway, we're going to focus a little bit more on what's been going on in the world of public equities, and that includes Walmart. The share is down fractionally on the day. A pretty decent quarter, and that was largely because they cut prices on a lot of their products. But the CEO had a warning about where those prices might go next. That's coming up right here on The Close on Bloomberg. All right, let's get a view from the sell side. Our top calls, big movers on the back of analyst recommendations. And we start off today with Pinterest. Wolf Research raising its recommendation to outperform on improving fundamentals for the social media company's performance ads business. The analyst also sees the macro overhang easing with that temporary U.S.-China trade truce. Shares of Pinterest, though, down about 2% here on the day. Next up, Cisco. Wells Fargo upgrading to overweight after yesterday's earnings results beat expectations. Wells cites Cisco's orders at 3 of the 6 largest hyperscalers and growing by triple digits, and says accelerating AI momentum should continue to drive the stock higher. Those shares actually having their best day since April 9th. And finally, let's take a look at Dick's Sporting Goods. TD Cowen cutting to hold and panning the retailer's decision to buy Foot Locker for $2.4 billion. He calls the deal a strategic mistake, saying there is little to no precedence of M&A at scale, creating value for shareholders within the softline retail space. Those shares down for a third day, in fact, having, I believe, their worst day going back to middle of 2023. Those are some of our top calls, and we do want to stay in the retail space and take a closer look at Walmart. The world's largest retailer reported strong sales and earnings growth this morning, but did caution that tariffs are increasing its costs, and, well, they may have to pass that on to the consumer. David Bellinger joins us right now. He's director and senior analyst of Hardlines, Broadlines over at Mizuho, and he's got an outperform rating on the stock. All right, let's start with the quarter that just was, David, because in that quarter, they also talked about how some of the transaction volume was actually aided by them cutting prices in the most recent quarter.
Yeah, look, we thought this was a good print. So Q1, you had same-store sales up 4.5% in the U.S. That's X the impact from gasoline. But you actually had each month of the quarter improved sequentially. They exited April on a good run rate. I thought they had some good commentary on the start to May. You actually saw some benefit here as it seemed like their internal sentiment readings got a little bit better. And there's not necessarily a pull forward here. Right? So some of the categories that got better late in the quarter included food. That's not necessarily something you buy because a tariff is going up.
Right.
And those products are essentially domestic source, but we thought Q1 was good. Some of this limited near-term visibility, we think that's what weighed on shares earlier this morning.
And of course, there was also the comments from the CFO that they are preparing for price increases as early as this month. Won't that be confusing to Walmart customers, consumers in general, if they cut prices in the lead up to tariffs and then now they're looking to raise prices?
So I don't think so. So that if you step back here, you think about this, how could prices not go up, right? You had 145% China tariff. It's good that it's down to 30, but it's still a big number for Walmart and their vendors to digest here. So we're going to see Walmart raise prices just like everyone across retail, but they do have the optionality to not do it as quickly. So things like food, they're trying to keep as low as they can, as long as they can. They even mentioned investing in some prices and cutting. And there you could see a lot of volume gains to Walmart. They've had this Walmart Plus business for over a year now. They've got what we think about 20 million customers within that program, a lot of upper income homes who are ordering items online. And we think that's very sticky. But Walmart here, they have these other highly accretive alternative businesses. They call it their second P&L. That's very unique to them. And we think that they could use that as a way to fund some of these price investments. And you should see the volumes pick up nicely.
Real quickly, David, do you anticipate, though, that we could see a bit of, I guess, a price war, if you will? I mean, I know Walmart's the only one that's really articulated right now where they might go on pricing. But at some point, we've got to hear from the other retailers next week and beyond as to maybe what they're seeing as well.
Yeah, I'd say maybe. But a lot of these companies are very much wired to protect their margin structure, right? So if you need to raise prices, you will. It depends on what you're raising them on, though. Yeah. So there's some of these big ticket discretionary items, tougher to do, but you could sort of put this peanut butter spread across the business, raise other items where you can.
All right, David Bellinger, Director and Senior Analyst of Hardlines, Broadlines, and Consumer Internet at Mizuho. Thank you so much. There is a breaking news headline here. This is from the Wall Street Journal. Meta will be delaying the rollout of its flagship AI model called Behemoth. You can see there the stock now down 2.8%. When the headline crossed, Meta shares definitely extended their losses and have deepened their decline. This raises all kinds of questions, Romain, about the direction of all the AI investments it's made so far.
Yeah, this is going to raise some new questions. Remember, they were supposed to roll this out at the start of last month, and they kind of put it off. And now, at least based on the journal's reporting, it does appear that it might be a little bit further off. And it raises a question like, where does AI stand in this? But should we read into now maybe what some of these other companies have been developing and whether we can count on those actually coming out on the previously anticipated schedule?
Absolutely. And of course, the Mag 7 was already down in today's trading, but this extends their weakness. NVIDIA also extending its losses now down about 1.1%. Speaking of the company that's kind of at the center of the AI build out right now.
Yeah, and of course, dragging down now the NASDAQ down only about 0.6%. The NASDAQ 100 down 0.3%. But material change in direction and sentiment right now based on Meta.
All right, we'll continue to keep an eye on those shares. In the meantime, coming up, we're going to be speaking with Ellen Zentner. She is Chief Economic Strategist at Morgan Stanley Wealth Management about the Fed's inflation fight and how tariffs may be delaying those efforts. This is The Close on Bloomberg.
.30 p.m. here in New York. This is the countdown to the close. I'm Romain Bostic alongside Scarlett Fu. Shares of Meta taking a big leg down over the last few minutes, down as much as 3%. This after a Wall Street Journal story that says that the company is delaying the rollout of its flagship AI model called Behemoth. Remember, Meta had been touting this, saying that it actually could outperform some of the products being offered by OpenAI, Google, and Anthropic. Mandeep Singh covers this for us at Bloomberg Intelligence. A surprise?
Well, so we know Meta had issues with the Llama 4 release, and the fact that they didn't release a smaller model and the Behemoth model was released first did raise questions. In this case, I think I'm not surprised because Meta was an open source model that everyone should have adopted. Even before DeepSeek, Meta had that advantage. And suddenly after DeepSeek, everyone kind of moved towards DeepSeek as the open source choice.
Yeah.
So clearly their model wasn't performing as well as the other options, and the open source advantage was slipping away from them. At the same time, they did raise the capex when they reported the results. So that was a surprise to everyone. Like, why are they raising their capex? Well, even though they raised the capex, it didn't really translate into better model performance, and now they are really going back to the drawing board in terms of who can revamp the model to make it equal to OpenAI and the leading large language models.
Right. The Wall Street Journal says Behemoth was initially slated to be released in April, and now it's been delayed to the fall or even later. And in fact, Meta is thinking about making management changes to the AI product group. Is spending more money on this, hiring better talent, new talent, going to solve this problem?
Well, they have the biggest surface area for deploying these chatbots. If you think about, the family of apps, Blue app, Instagram, WhatsApp, they have the engagement. They have the surface area to monetize the engagement using chatbots. It's just they don't have their own model. Maybe a partnership with a Claude or one of these models may serve them better because they have the compute, they have the application, they just don't have the most performing model. And in this case, that's what they're trying to fix here.
All right, Mandeep Singh, really appreciate it. Mandeep Singh, of course, with Bloomberg Intelligence, giving us the instant analysis on news that Meta will delay the rollout of its flagship AI model, Behemoth, at least according to Wall Street Journal reporting. All right, let's shift from Meta to monetary policy, because Fed Chair Jay Powell earlier today had this to say about the Fed's average inflation targeting.
In our discussions so far, participants have indicated that they thought it would be appropriate to reconsider the language around shortfalls. And at our meeting last week, we had a similar take on average inflation targeting.
For more on monetary policy and the economy at large, let's bring in Ellen Zentner, Chief Economic Strategist at Morgan Stanley Wealth Management. So the Fed is reconsidering, and is reconsidering a lot of things right now because so much is in flux. What we know is that it's not going to do anything at the moment, even as people speculate there might be a more dovish Fed because of today's data dump. What is your take on the data that we got today, showing that retail sales were kind of muted, wholesale inflation actually cooler than anticipated? What's the takeaway?
Well, so I think retail sales were muted because this is the April data that we just got. We know that there was some front loading ahead of the expectation that tariffs would hit prices. I think there's more front loading to come that's going on this month. So I think when we get retail sales next month also, we'll probably see a little bit of that front loading continue. But really, in terms of the inflation data, this is the month that it's hitting. So when we got CPI and PPI this week, that's April data. So you can kind of say, well, that's great. Before the tariffs hit, we were in a disinflationary trend. Unfortunately, we know what's coming. And I think what's so interesting to me is markets breathe this big sigh of relief that tariffs on China are not going to be 145%. They're going to be only 45%. But at the end of the day, that is double what they were in January. When you look at it on a trade-weighted effective rate, it was 20% in January. It's 40% now. That is double. That's significant. And so I think we're going to be back to markets are pricing in all the good things and none of the bad. The bad has not shown up in the data yet, but it is coming. It is coming.
At what point does it come? Because at the wholesale level is when you're going to see it first before then it trickles down to the consumer level.
So I think you're going to see, let's say when we get into the next earnings season or even in the late summer before that, when companies are really trying to posture we didn't see as sort of dire forward guidance as you would have expected in the first quarter. And I think probably because tariffs were so uncertain, I think you knew that some margin squeeze was going to come, but do you want to really guide toward that when you're not really sure what the outcome might be? Well, now they're on a footing where you could end up disappointing. And so you've got to do some sort of pre-guidance before the forward guidance in the earnings season. So, these companies that don't have a lot of pricing power are going to feel it on the margin. And I think investors will sniff that out before we get to the next earnings season.
I'm going to ask you a really dumb question, because when I was reading the PPI report today, and they kind of made this, you read in between the lines, you could kind of see that there was this issue that a lot of these companies apparently might actually be taking that price right now. And as we heard from Walmart, they may not do that for long. Is it better? What is the impact on broader economic data points? So like GDP, retail sales, and things like that. With the price action or the price pressures are on the wholesale side and being absorbed by the company or passed on to the consumer, or does it not matter?
Well, so tariffs always fall here, there, and everywhere.
Yeah.
So there's going to be some that the producers absorb, some that will have to be absorbed on the margin, and some that are going to be absorbed by the consumer. So what you end up seeing is, to the extent margins are getting hit, you're going to see it in valuations, you're going to see it in business investment, because they have to pull back. Now they also then have to bear costs, and so you probably then see it somewhat in higher layoffs. And then at the consumer side, consumers are going to, we're not indiscriminate buyers anymore. So they're not going to just demand the same exact amount, even though prices increase. And so businesses are going to also feel it on their bottom line.
So another side of this whole economic, I guess, trying to read the tea leaves on it, is this idea of kind of where we go in the labor market, where we go with regards to productivity. We were just talking about AI with Meta. I mean, that in theory, long term, is supposed to be maybe additive to productivity here. I am curious if you see that coming soon, that could actually be a tailwind for the economy and for the labor market.
Well, so it absolutely can be a tailwind with driving productivity. We've got great productivity numbers right now. And I'm going to echo what some of the other sort of economists, academics are saying, in that what we're seeing right now is normal in a business cycle, that we've gone through a long period of very tight labor markets. Businesses seek efficiencies, and as they deploy those efficiencies, it drives productivity gains. And that's just a normal cyclical feature. However, I am very optimistic about AI and what it can provide in terms of a tailwind to the economy and to productivity. And I think it's very important that we are in a two-horse race with China on AI. I think it's very important that we limited the H20 chips from NVIDIA to China or countries friendly with China, because it still keeps us ahead in that two-horse race. Probably a little bit, if I think further out on the horizon, China's going to be able to scale better than us when the technology tops out, but we are still developing faster. And I do think that the sky is the limit when we think about what all productivity gains it can provide. There are ethical issues. These are, very scary things that we can do with AI, but there are probably some very beautiful things too. And I think that some of the uncomfortableness is probably just natural in a technological revolution. But what does that mean? Probably within the next year or two, we start to see more and more of those productivity gains that we can point to and say, aha, that's AI.
You talk about China and U.S. being in this two-horse race when it comes to AI. But this week, we've seen a lot of deals announced in the Middle East, with the president making his big trip through the region, and especially when it comes to U.S. companies providing hardware to companies in the Middle East, in Saudi Arabia, for instance. What does that mean for that region's development of AI and how that looks geopolitically?
Yes, I think the Middle East is very interesting and maybe gets another horse into the race, and a horse that importantly is friendly with the U.S. So the Middle East knows that they need to diversify and diversify away from oil, and they've got the capital to do it. And so you've also got tremendous upside for data center potential. And now you've got partnerships with the U.S. to get the chips that you need. And so I think that can quickly ramp up. And so I think that it's important that as we see more horses enter the race, that they are countries that are friendly with the U.S. And staying friendly with the U.S. means you probably will get the high-speed chips that you need. I also think in that regard, the U.K. could be interesting. We saw that with DeepMind, the government was helpful in Google developing DeepMind there. And so I think the U.K. could be another interesting horse in the race.
Are there some of these relationships or partnerships, whatever you want to call them, is that enough to sort of fill whatever hole is left by China not being sort of in the party?
Well, we hope.
Yeah.
I think that there's room for more. I don't think there has to be just one or two big players in AI. I think there can be large partnerships in how we harness AI. I think there's also a lot more on the regulatory front that needs to be done on sort of the ethical side of this as well. But I think, as is typical, the technology is progressing at lightning speed, and regulation and policymakers are not going to be able to keep up with it. But in a sense, that's the only way you can win this race. I had the absolute pleasure of talking to Secretary of State Condoleezza Rice back in December, and she's been touting the run, don't walk toward AI. And the way we've stayed ahead in this race, say, versus Europe, is that we're adopting now and regulating later, whereas Europe is regulating first and adopting later, and you're not going to win that race that way. But it also means that we are moving at the speed of light, and then policymakers are going to have to catch up.
All right, Ellen, always appreciate you coming on.
Thank you.
Ellen Zentner, Chief Economic Strategist at Morgan Stanley Wealth Management. And of course, another leg of this whole stool when it comes to the president's policies, of course, has to do with trying to bring more manufacturing back to the U.S. An interesting comment by the president during his trip in the Middle East, saying that he asked the CEO of Apple, Tim Cook, to stop building plants in India to make the iPhone. Joining us right now is Mark Gurman, who covers all things Apple for us. And Mark, kind of break this all down. I mean, it's been very public that Apple has been looking to diversify its supply chain. It has struck deals with manufacturers in India. And now you have the president basically saying, don't do that. Where's Apple going to make iPhones if they can't do it in China and they can't do it in India?
Well, just because Donald Trump says you can't make iPhones in China and you can't make iPhones in India doesn't mean that Apple's not going to make iPhones in China and iPhones in India, right? He doesn't have that kind of power. Obviously, the tariffs are something that are going to impact where Apple's going to produce its devices. But if he wants to hit Apple, he can't just put a tariff on Apple, right? But he can hurt them in certain respects. But there's no solution here, right? It's going to either be India or it's going to be China. Maybe it could be some other Southeast Asian countries, places like Malaysia, Thailand, Vietnam,
but how fast
where it's not going.
But Mark, how fast can they even shift? I mean, they've been sort of doing this India thing for a long time now. You're talking about 20% of their production in terms of devices is now coming out of India?
But there is no shift. Okay. It's China to India. There's no additional shift. There's no moving again, right? These phones are being produced in China and India, maybe other parts of Asia. These phones are not going to be produced in the US. There's no magic lever or magic genie in a bottle that can get this to happen. It's just not feasible from an engineering standpoint, from a cost standpoint, from the resources that it would need to move, to build up contract manufacturing, to build up engineering education in the US. It's just, there is no shift. It's India, which is already happening, China, maybe other parts of Asia.
So we know that Apple assembled about $22 billion worth of iPhones in India in the 12 months through March, and that's a pretty big leap over the same time a year ago. What's been the cost of doing that, of moving some of that production to a country like India?
Well, they've spent billions on new partnerships, new manufacturing facilities, new places to actually develop the products. That has been an expensive endeavor. It's also been expensive because you're putting resources towards needing to build new manufacturing facilities and re-engineering the devices to be built elsewhere. And that's time that could have maybe been better spent building the device, building new versions of the devices or innovative new features. So certainly this has all had a cost on people, monetarily, and on future products.
So you've made clear that the iPhone, moving the iPhone and the manufacturing of that device to the U.S. is an impossibility given the resources we have on the ground here in terms of human resources, the talent, the skill set, the capacities, the facilities. What about other iProducts? Apple does make some iMacs, I believe, in the U.S. I mean, could it fulfill some of President Trump's requests by boosting its manufacturing of other devices here?
That's exactly what I expect Apple to do, is start producing something else, maybe some accessory, maybe device packaging, lower level, easier types of things. You could make a couple of the additional Macs, maybe a Mac Mini in the US. You can maybe make certain types of iPads in the US. So what you'll see is they'll probably make an announcement sometime in the next few months that they're going to start producing some Mac desktop, some iPad, some additional chips, some iPhone components, some iPhone packaging in the US, right? But in terms of this thing right here, it's not happening.
All right, Mark Gurman, thank you so much. Bloomberg's Mark Gurman, who covers all things Apple for us here at Bloomberg News. And Romain, there was a Bank of America report that said that if Apple were to make the iPhone in the U.S., it'd be upwards of $3,000 per device.
Yeah, I mean, financially, there's just no way that's going to happen anytime soon. But it just also gets to this idea, too, that, you just can't shift supply chains around as quickly as maybe the president wants them to, as Mark pointed out. So.
Absolutely. All right, coming up, Nguyen of Research Affiliates will help us count you down to the closing bells as we look at an S&P 500 that is up by 0.25%. From New York, this is Bloomberg.
consumer discretionary has been sort of front and center of where tariff impacts are going to show up most directly and most aggressively. So as you begin to peel back the worst case for tariffs, you come back to that sector, and then you've got names like Amazon, which have been caught up in that sell-off that presumably have room back the other side.
Scott Chronert over at Citi kicking us off to the close just about 50 minutes ago. And of course, the big sell-off that we had back in April is providing, I guess, some degree of opportunity if you are looking for an entry point, and I guess if you have some confidence about where economic and fundamental conditions go next.
Well, that's a really good point. Is it confidence when everyone is bidding up classically defensive sectors like the telecoms, food and beverage, tobacco stocks, and household and personal products? Because those are the groups within the S&P 500 that are up by at least 2.5% right now. And the S&P 500 itself only up by 0.4% because big tech is under pressure. But what does it say when everyone's going in, flocking to those defensive stocks?
So you're saying I shouldn't be celebrating the fact that, you know, Steris is the number one best performing stock in the S&P?
I would
American
pause.
Waterworks is number 4. But, you know, there's something for everybody out there, Scarlett. Not everybody wants the, you know, the sizzle of the Metas and the Apples of the world. Maybe there is life out there beyond big tech. Nguyen is a partner and CIO of equity strategies at Research Affiliates, and she's devoted her career to looking for those opportunities, and great to have you here.
Thank you.
I am curious about small caps. I mean, at least today we're seeing relative outperformance, but there was a stretch before some of the turmoil where we had saw some pretty consistent outperformance by some of the main indices that track small cap stocks. And I am curious as to where they fit in an environment where people are coming back looking for bargains, but at the same time, we're still kind of waiting for economic data to maybe ratify a lot of the fears we had about the impact of tariffs.
So one of the things about the stock market is that it prices in economic expectations before you actually see the numbers. What we saw was a big drop in the S&P due to uncertainty about tariffs, leading to uncertainty about the economy. What we're seeing now is that that's kind of over. You know, unless Trump regresses back to where he was before, which seems very unlikely, or does even worse than what he did before, which seems even more unlikely, really the expectations, or the worst of the expectations, are really behind us. So, you know, I think that, are we going to get a recession later this year? Probably, but to some degree, the stock markets already know that.
Yeah, but when we saw a rebound in a lot of these stocks, and obviously, you know, big tech sort of led that rebound, but it was also interesting to see all the tariff-exposed stocks also get a pretty strong bid. A lot of retailers, apparel makers, sneaker makers who have outsized exposure to the Chinese supply chain were bid back up. Now, they haven't gotten back to their pre-sort of Liberation Day levels, but they look like they could maybe potentially get there. Do you see an opportunity for that?
Sure. I mean, I definitely see opportunity for that. I mean, people aren't necessarily going to stop buying things. They may shift their consumption basket. They may buy less of one thing and more of the other. But ultimately, the consumer data that's come out in the U.S. has been relatively resilient. I mean, some of that is the front loading, but also you don't necessarily see employment falling off a cliff. I mean, yes, I do think that employment's going to slow, but at the same time, I think that there's a lot of retailers out there that are well positioned and that are cheaply priced.
And we'll be getting some of those results in the coming weeks to really get a sense of, you know, how much pressure they feel at the moment. You mentioned how, you know, the president could kind of turn things on a dime. It's been made clear that there is a Trump put. Is it in the bond market or is it in the stock market right now?
I really think it's in both. I do think it is in both. Now, I think the strike may be a little bit lower than some people would like, but I do think that it really is in both.
So in the bond market, where do you think the strike is at? Where do you think it's at in the stock market?
So I think that Trump is not necessarily against having yields be high as long as the growth justifies it. I think what he was particularly annoyed by is just the disorderly nature of how the bond market behaved, right? So when people were expecting there to be a recession, you saw bond yields spike, right? Basically saying there's a lack of confidence in the United States as a sovereign. So I think that's really where it comes in. I think that what he really is looking for is not necessarily a ceiling on yields, but really a ceiling on yields relative to the outlook for the economy.
And also, I think to a certain extent, maybe relative to the value of the dollar as well, which seems to be a big component that they're also trying to address. So how do you sort of model that in, or do you not? Do you just sort of just wait until, we actually see a real result?
So I don't think this, I don't think that there's a lot that's changed in the immediate present of the dollar and U.S. bonds. Mm-hmm. The U.S. dollar is still the reserve currency of choice. Mm-hmm. Now, has what happened undermined that position? Probably, but since there aren't really a lot of other options out there, the move out of the dollar or the de-dollarization that could happen is going to happen probably very, very gradually. So, in that sense, long term, yes, there should be a higher risk premium on all U.S. assets, including the mega cap stocks, right? Yeah. And so for us, that's why we...
Is that premium there, though? I mean, I think I see a little bit in equities, certainly not in fixed income. Or long term, or at least long duration.
Long duration, it's not, because, again, there's really no alternative, right? Mm-hmm. But going out 5 years, 10 years from now, I think there will be a gentle de-dollarization.
So, Quay, Scott Chronert was on earlier from Citi, and he was saying growth stocks are now your defensive play at the moment. I know you've been looking at small caps because of the incredible value, the opportunity that they provide. Within growth, is there value still there?
Within certain areas of growth, there's still value there. I mean, I think that one of the things that you see, for example, is you look at the Mag 7, right, and you have Alphabet. It's trading at 17 times. It's a discount to what the S&P is trading at overall. Apple, it was trading at 40 times last year. It's now trading at 30 times earnings, right? Partly because prices, the stock price has stagnated, but earnings continue to grow. Mm-hmm. So I do think that you do find some value or increasing value there, opening up opportunities. I wouldn't necessarily rule out investing in some of these growth stocks or some of these technology stocks. But at the same time, I think there's a lot of other very, very attractive opportunities outside the mega caps.
All right.
All right, Quay. Always great to talk to you. Nguyen, partner and CIO of Equity Strategies at Research Affiliates, helping us count you down to the closing bells. Just about 2.5 minutes to go. And Scarlett, stocks continue to oscillate between gains and losses. The Dow and the S&P holding in the green, the NASDAQ in the red, dragged down partly by that drop that we saw in Meta.
Yeah, absolutely. And that was news that just came out in the last hour or so that Meta is delaying the rollout of its AI behemoth model. And of course, that raises all kinds of questions about what it means for the rest of the AI ecosystem and where they stand. We have seen stocks move from being oversold to overbought awfully quickly, and it's a matter of figuring out where we're at. Yeah,
our RSI, though, on pause right now as we move closer to the closing bells. A full breakdown of all of today's market action starts right now.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Scarlett Fu, taking you through to the closing bell with a global simulcast that starts right now. Tim Stenovic in the radio booth, Emily Grafeo in today for Carol Master, Alex Steele on assignment as we welcome our audiences across all of our Bloomberg platforms, television, radio, and our partnership with YouTube. Tim Stenovic, an attempt here. Oh, wow, I looked awful in that picture. Tim Stenovic, what do you make of this mini rally, if you will?
I guess. I don't know. In the context of what's happened since April 8th, it's kind of not much, but it's pretty remarkable to see the rise in equities just in the last 5 weeks or so from those lows, because what, Emily, we're up 20% since then?
Yeah, about 20% since the April 8th low, which is just incredible here, really the strength of the rally. So maybe all of the fears about an upcoming trade war are just not on investors' minds anymore.
Well, 25% if you're talking about the NASDAQ 100 since that April 8th low, which just gives you a sense of how quickly things can shift. The question now is what happens next and which headline we would be looking at in terms of whether it's going to be earnings or some kind of tariff update that could give us the next leg up.
Well, that's what I'm curious as to what the next catalyst would be. I mean, we've kind of gone through the meat of earnings season. I know we get a few retailers next week that might shed some light on the tariff situation. But beyond that, we're down in that sort of zone where it's going to be maybe much more driven once again by Washington and maybe not by the White House. I mean, remember, Congress is finally getting around to addressing some of the other fiscal proposals that the president had on the campaign trail. We'll see if they can make it through the gauntlet in Washington. Meanwhile, here on Wall Street, we do get the closing bells, and we do have green on the screen for most of the major indices, including a 0.7% gain for the Dow Jones Industrial Average, up about almost 300 points on the day. The S&P higher by about 25 points, going to close above that 5,900 level, a gain of about 0.4%. The NASDAQ 100 is going to finish the day in the green, only about 0.1%. We should point out the RSI, basically the relative strength indicator that I guess determines overbought or oversold conditions, that remains in overbought territory. The NASDAQ composite, though, is down 0.2% on the day, and your outperformer on a relative basis comes from two different areas. One, the Russell 2000 up 0.5%, and the other, the S&P 500 equal weight index, which is up 0.9%.
Okay, look at that. In the S&P 500 non-equal weight index, 375 stocks did move higher. We did see 128 stocks move lower, though. I guess it would be the same in the equal weight index too, Romain.
I don't know. Is that true?
The number of decliners and advancers, yes, that's the same.
Yes. Yeah.
Whether it's
just
a non-equal weight or
just doing some quick calculations in my head, it would be the same.
It would be the same. You're right. All right, let's take a look at what happens when you look at it on a sector-by-sector basis.
Now I'm kind of doubting that. I don't know why.
Because I said it.
Because I know it's. Go ahead.
Well, it's because the equal weight index is higher than the market cap weighted index that this IMAP looks kind of lopsided, right? Because you have tech, communication services, and consumer discretionary. These are the three sectors that encompass megatech. They are the only sectors in the red, but you could see that they take up fully half of the pie. Utilities, consumer staples, real estate investment trusts doing the best, all up at least 1.8%. These are all dividend-paying stocks that are classically defensive, so it tells you where investors' heads are, at least for today.
Hey, before we get to the gainers and decliners, we are getting some earnings. Speaking of tech, Applied Materials, of course, in the semiconductor space, saying that net sales in the most recent quarter did come in a little bit light, roughly about $7.1 billion. The street was just looking for just a few million more than that, so a modest miss on that front. And on adjusted EPS, they did beat $2.39 a share. The street was looking for $2.31 a share, and the company says that for the fiscal third quarter, so basically the guidance for the fiscal third quarter, they do see net sales in a range, a pretty wide range of 6.7 to 7.7 billion. The street on average, Tim, was looking for 7.2 billion. Okay, there you have Applied Materials down about 1.9%. A reminder, we're still expecting results from Take-Two, Virgin Galactic, Kava, and a few more as well. In the meantime, I do want to take a look at some of the gainers on my radar today. Got to start with Foot Locker having its best single day ever, 85.7% to the upside. This after we learned that Dick's Sporting Goods agreed to buy the company. It's a cash or stock deal. It implies an equity value of about $2.4 billion and an enterprise value of about $2.5 billion. But even though this is the best day ever and the stock surged 85%, it's really only at levels that were last seen just in December of 2024. The stock has gotten hammered really in recent years. It's kind of interesting, too, to see some of the analyst notes on that. I mean, really just kind of slamming this deal. I mean, TD Cowen was basically just saying, I just don't get it. You know, $2.4 billion or whatever they're paying for Foot Locker and the softline retail space to scale up. Look, Dana Telsey was on our program a little earlier from Telsey Advisors. She's really optimistic about this. She said, wait and see. She reminds everybody the way that Dick's Sporting Goods in recent years was able to really reinvent the way that it sold things in its stores and attract this demographic that isn't necessarily attracted to the Foot Locker stores. So like young men, 18 to 25, for example. She's pretty optimistic about this. I set foot in the Dick's the other day, last Saturday, to get something for my wife, a T-shirt. I hadn't been in one in a long time. I have to say, they were insanely friendly in there. All of the people were. Yeah. I mean, because I didn't know what I was looking for, and they were really helpful. It was quite an experience. Yeah. I won't go back, but it was quite an experience. Did your wife like the shirt? She did. It was very great. So I'm doing my part here. Okay, Nike, you are. Nike shirt. All right. Happy Mother's Day. Look for that in the earnings. Yeah. All right. Cisco. Let's look at what shares of Cisco did. They ended up rising on the day today. This after the company issued a solid forecast for revenue, up close to 5% today. Solid forecast for revenue for the current quarter. Sales expected to be $14.5 billion to $14.7 billion. The company, like many others that have reported in recent weeks, is benefiting from demand for systems using AI tech, corporations and cloud computing providers expanding their networks to handle the surge in AI software. We also got some news about a little executive shakeup at the company, including the departure of Scott Herren as the company's CFO. Once again, shares of Cisco up by more than 4.8%. And finally, back to retail, Birkenstock Holding, BIRK, shares up close to 6% today.
The company raised its earnings forecast for the year due to strong sales of its high-end sandals, expecting adjusted earnings of $740 million to $750 million. Sales rose 18% on a constant currency basis. They saw growth in all regions, including Americas, Europe, Middle East and Africa, and Emily, Asia Pacific.
It is sandal season coming up, and so that makes sense why, sales would be going up and people are bullish. I put a couple of things in my shopping cart not so long ago. So there you have it. Let's also look at Take-Two because those results just came out. And the ticker here is TTWO, and we are looking at the first quarter. Let's give you the numbers for the quarter that ended. Fourth quarter adjusted EPS was $1.08 compared with 28 cents a year earlier. Not sure we're comparing like with like here, but in terms of adjusted EBITDA for the period, $291.3 million does miss the average analyst estimate, which was just under $310 million. As for the outlook, it sees first quarter adjusted EPS of 20 cents to 30 cents, and it sees net bookings of anywhere from $1.25 billion to $1.3 billion. Analysts were looking for, on average, $1.27 billion. Right now, the stock is lower by about 5% in after-hours trading.
Okay, I'm watching what's going on with Virgin Galactic, ticker SPCE up 3% in the after hours. Some headlines crossing. Astronaut sales are expected to open up in the first quarter of next year. We also got results from the company. First quarter revenue beat estimates, did report a loss per share of $2.38 versus a loss per share last year of 25 cents. The company sees second quarter negative free cash flow from $105 million to $115 million. The estimate for the cash flow was a negative $106.1 million. Shares higher by about 3.6%. First quarter revenue coming in just above estimates at $500 million. Is that $500 million? Yeah, $500 million. Adjusted EBITDA loss of $72 million. The estimated loss was for $70.9 million. Excuse me, that's $500,000 for first quarter revenue. Excuse me.
Those shares higher right now, but let's look at some of the decliners today. United Health shares closed for the 8th straight day, closing lower, down 11%, but the stock did plunge as much as 19%, hitting the lowest level since April 2020 after the Wall Street Journal reported that the health insurer is under criminal investigation for possible Medicare fraud. The company said in a statement late yesterday that the DOJ hadn't notified the company about the reported investigation, and they said, quote, "We stand by the integrity of our Medicare Advantage program," but still a really rough string of days for that company. I'm also watching shares of Meta. That stock closed down 2.4% after the Wall Street Journal reported that the Facebook parent is delaying the rollout of its flagship AI intelligence model. It's called Behemoth, but we'll have to wait a little bit longer to see that full rollout. And finally, Coinbase shares closed down 7%. It was the worst day since March 28th, and this is just after it was announced that it was added to the S&P 500. It was up over 20% earlier this week, and yet this morning got hit with two pieces of news that really weighed on the shares. First, a hack over at the largest crypto exchange. Hackers had near constant access to some of Coinbase Global's most valuable customer data since January, according to Bloomberg reporting. And then additionally, the New York Times reported that the SEC has been investigating whether the company misstated its user numbers in past disclosures.
All right, and we should point out Bitcoin right now down fractionally on the day. So too is the dollar, and down in a big way are Treasury yields, roughly about 9 to 10 basis points across the curve as a lot of people now start to reprice in what they expect the Fed to do. That, of course, that was on the back of that slew of economic data that we got this morning. A real mixed bag here for economic conditions that at least has some investors thinking the Fed might actually act.
All right, we'll have to wait and see. Scarlett, you mentioned what's the next catalyst. Do not forget May 28th, NVIDIA earnings.
Yes.
Maybe that's the big one.
That's what, still another 2 weeks away.
Still another 2
There's
weeks
a lot of meandering
I got
between now and then.
I got to look forward to something, okay?
Sounds good.
Okay, that is going to do it for our cross-platform coverage of the market close on Bloomberg TV, radio, YouTube, and at Bloomberg Originals. We're going to be back tomorrow, same time, same place.
And our coverage continues here on Bloomberg Television. A closer look at global markets, specifically emerging markets. A conversation up ahead with Hans Humes, the CEO over at Greylock Capital. He's going to talk about the landscape as well as some of the deals, maybe, that did not actually happen today. That's coming up next, right here on The Close. This is Bloomberg.
The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
All right, welcome back to The Close. Romain Bostic here with a wrap-up of how markets sit today. Fractional gains across the board for most of the major indices. The NASDAQ Composite sitting this one out, down about 0.2%, but the S&P gaining about 0.4% here on the day. But it was very defensive in nature. You did not see a lot of those big cap tech names leading the charge. It was a lot of folks in the healthcare space, and as you can see there, in the utility space. In fact, the Philadelphia Utility Index up about 2% here on the day. And of course, you saw that big shift in yields. A lot of people looking at economic conditions and now making a bet here that maybe, just maybe, the Fed will indeed actually cut rates sometime soon. Some notable movers here in the after hours trade as earnings do cross the wire. Applied Materials, Take-Two Interactive, and Kava Group each down about 3% here on the day. Applied Materials reporting, of course, they are the largest maker of chip manufacturing equipment. Some of the guidance that it gave, a very broad guidance, I should point out here, as some of that uncertainty is there. A low end of that guidance, well below the average of street estimates. A similar story for what we saw with Take-Two and Kava Group. Of course, the fast casual chain just crossing the wire right now. That company saying that in its fiscal first quarter, EBITDA did come in slightly above estimates, 44.9 million. The street was looking for 43.8, and revenue also coming in at a slight beat at about 332 million. The street looking for 326. We should point out the company is saying that for the full year, it does still see comp sales in the 6 to 8% range, so a ratification of its previous guidance that it had given the market. We want to turn now to our top story for the next hour, and that really is the bid into global markets and specifically into emerging markets assets. And a lot of questions out there as to whether that rotation is justified. So far, so good. Because through all the global turmoil this year, emerging markets have proven to be an unexpected winner. EM stocks as a group sitting on year-to-date gains of about 9%. An index of EM currencies has rallied 5%. And the risk premium on emerging market debt this week has been narrowing at the fastest pace since 2022. The head of PIMCO's EM debt business telling Bloomberg earlier today that investors are taking advantage of high yields and improved fundamentals to buy up local bonds in developing nations, which as an asset class are off to their best start to a year since 2017. The outlook, though, hinges on some sort of resolution to Trump's trade spat and, well, some semblance of a resolution to military conflicts, including Russia's war in Ukraine. Joining us now to break it all down for us is Hans Humes. He's a CIO at Greylock Capital, and he has made a living restructuring distressed debt from troubled nations, including Greece, Ukraine, Argentina, Venezuela, and I'm probably forgetting quite a few others. Great to see you, Hans. It's been a long time.
Yeah, it's been a long time. Thanks for having me.
It seems like the opportunity right now might actually be ripe in some of these markets, and I am curious if you're actually finding opportunities or value, I should say, out there.
Absolutely. I mean, I think the thing that people should take a look at is what Trump said in Saudi Arabia 2 days ago, and coming out and unilaterally lifting the sanctions on Syria. And the language he used with that points to potentially a complete game changer for EM. One, he identified sanctions as being ruinous. And then he had this additional comment about U.S. presidents have always made the mistake of utilizing U.S. policy because they've looked into the souls of foreign leaders. So, in effect, what he was saying is like, I'm about commerce, not chaos. And identifying the use of U.S. policy when we make a moral judgment is huge. Because the opportunities that exist in these countries when you strip out our point of view. Syria is a small case. You take a couple steps back and you look at Ukraine as a sort of proof of concept deal. I quickly took a look at 5 countries, just 5 countries. And if you give the U.S. first mover advantage in those countries, you're looking at commodity wealth of $90 trillion.
Wow. Do you think, though, he's going to be consistent on that? And I'm talking about across these various countries, or is this going to be just a country-by-country basis based on his own feeling about, who he thinks deserves a reprieve?
My feeling is he's got a particular point of view on how things should be managed, and it should be, basically a business-led. If we're going to have boots on the ground, there should be boots of guys dressed like you and me, not military. And he has come out clearly and said sanctions aren't the way to operate. So I think below it all,
Yeah.
this is his mantra.
Yeah, and he made that clear on the campaign trail, at least
Absolutely.
in general, about this idea that he does not want the U.S. to necessarily be the moral arbiter that I think we've tried to be for decades. I am curious, though, about this idea of rebuilding some of these nations, because you can remove sanctions, but we're also talking about countries that are devastated. Syria devastated, Ukraine devastated. Even when you look at countries like Venezuela, you're talking about
Iraq.
You're talking about a huge climb economically.
Yep.
And that's going to require a lot of investments. And obviously that might benefit investors, but I am curious as to the risk in getting to, I guess, the promised land.
I mean, obviously, you're going to have risks in all these countries, and you have inevitable economic distortions that are created when you have sanctions. You start creating economic interest for getting around sanctions. But take a look at the sort of the raw numbers of mineral wealth you're dealing with. Venezuela, potential $30 billion. You've got Iraq with $20 billion. And the reconstruction in these cases, obviously different outcomes. I mean, I'd argue in Iraq, we would have some responsibility for participating in it.
Yeah.
But rather than putting sort of government money or development money in there, make the countries our partners and give U.S. companies first mover advantage. There's not one of the countries of the 5 that I chose that hasn't reached out to the U.S. or expressed an interest in having U.S. firms involved.
Do you think the U.S. government, though, will be at the forefront of that? And by that, I mean, in some of those nations, there is potentially competition coming from the world's second largest economy as they try to sort of influence the world in their own way as well. And I am curious as to how that's going to play out. Are these countries going to have to pick and choose one or the other, or is there sort of room for everybody in the pool?
I went through a lot of discussions with Zambians when we did their debt restructuring, and you couldn't get a better example of the tension these countries feel. But I would say in general, countries prefer doing business with American companies. What we have allowed China to do, they're seeing this $90 trillion opportunity, and they've been looking at it for a long time, and they are allowing themselves access. We've kind of created barriers and put U.S. companies as a disadvantage. 2 days ago, that might have changed. And structurally, all we need the U.S. government to do is open the playing field and give us that first mover advantage to take advantage of the opportunities.
I want to go down to Argentina for a second, because you've obviously had a big presence there for a long time. What do you make of it? I mean, Milei has, he came in, a lot of people thought he was crazy, but he's put in some policies that have certainly had a net benefit to the economy there. Are you pleased with the direction that government and its policies are having right now on the economy? Yeah,
and I think Milei's approach and what happened sort of behind the scenes in terms of giving him the room to push, his policies. It sort of gives a lot of credibility to the idea that go for the shock. And I think Milei as a person and the craziness that people say actually is part of why he's been able to do it. I mean, people like him. They're entertained by him. And I think that in general, I mean, we're not out of the woods with Argentina yet, but the numbers speak for themselves.
But is it like in a much better position than, I don't know, if we had this conversation even 5 years ago? I mean, you feel more encouraged now?
There were some structural problems that Argentina had to resolve for it to function. I mean, bloated bureaucracy. I mean, I'll give you the data points, but, province of Buenos Aires has the same level of debt that they did 10 years ago, and they have 2.5 times as many employees. They need to get the public sector down and revitalize the private sector. I mean, I can go into the weeds, but we probably don't have the time to do that.
All right. Well, we're going to bring you back, and maybe we can get into the weeds. I can talk to you all day. Hans Humes there is the CEO and CIO over at Greylock Capital. Thanks, Hans.
Thank you, man.
All right, coming up here, we're going to go down to Washington. The tax battle on Capitol Hill is underway. Courtney, Rickert, McCaffrey going to be joining us in just a second. Insights leader over at EY. This is The Close on Bloomberg. All right, let's go down to Washington, where a tax battle on Capitol Hill is playing out. House Speaker Mike Johnson reiterates that Republicans are close to reaching an agreement on the state and local tax deduction, but there are other big sticking points as well. At least 14 GOP lawmakers, at least for right now, saying they're not willing to sign off on this. Courtney Rickert McCaffrey joins us right now, Global Geostrategy Insights Leader at EY. And Courtney, I want to start off first domestically in terms of what's going on down in Washington, because when we talk about the president's trade policies, it was always promised that this was part of a much more holistic approach. The idea that we would get tax cuts, we would get budget and fiscal measures that would maybe blunt the impact of maybe what we're seeing with tariffs. When you look at the state of the tax bill, when you look at maybe whatever progress is being made on other budgetary issues, do you think we're going to get there?
Well, that's the $1 trillion question, right? I think tax bills, any big bill in Washington, and tax bills in particular, are always messy. There's a variety of different interests at play, different priorities, even within the Republican Party, of course. And so, nobody expected this to be sort of an easy or quick process. So I think they've moved very quickly this week. In fact, there's been a lot of progress. As you noted, there's some disagreements, but I think it's too early to say exactly how this is going to pan out. I think what we're hearing from companies, though, is that what they really want is certainty, certainty on the tariff landscape, as you already mentioned, but also certainty on the tax landscape so that they can plan for the future better.
Do we have that certainty? I mean, we had that, I guess, a temporary truce, at least right now, between the U.S. and China. But just generally the sentiment in terms of what you've heard from the president over the last couple of weeks definitely seems to be a little bit more genteel than maybe what he was saying 4 or 5 weeks ago.
Yeah, I think things are certainly trending in a positive direction in terms of a lot of these bilateral negotiations. We obviously saw the U.S. and U.K. make some announcements about a deal. That the U.S.-China deal was certainly welcomed by a lot of companies, a lot of executives around the world. It sort of eases a lot of the short-term constraints, although, of course, tariffs are still high, still significantly elevated relative to where they were in January. So I don't think we're there yet in terms of having that medium to long-term certainty, even though, some of the recent steps have been more positive.
I mean, we've heard a lot of commentary during this earnings season from CEOs and CFOs. And it all seems to be about the same, this general idea that there is kind of a wait and see, if you will. A lot of companies really haven't done anything, adjusted anything just yet because they don't really know where things are going. When do you expect to maybe hear a little bit more, I guess, of a definitive idea of what these companies are going to do if they are indeed going to pivot on some of their pricing, investments, hiring, et cetera?
Yeah, absolutely. There's definitely been a wait and see attitude, although I will say I think things are starting to move. We're seeing some pricing moves, for instance, by some of the bigger retailers and some other sort of B2B companies. So that's certainly something I'm hearing in a lot of the conversations I'm having with CFOs and others. And then I think there's a lot of thinking going on in terms of longer term planning. So maybe not making changes yet until we get that clearer picture and that certainty, but making some scenarios about different ways that the tariff landscape could change, how that might affect supply chains in the future, and trying to think through what some of those no regret moves might be in terms of supply chain diversification, localization, and building resilience.
But that gets to this idea of whether there'll ever be certainty. I mean, we talk about supply chains. We just had a report out of the Wall Street Journal just a few minutes ago that, apparently Trump said that he called Tim Cook and said, stop moving production over to India. I mean, they've been doing this for years now.
Yeah, absolutely. I mean, and this gets to just how complicated global supply chains are, right? It's not just about, the U.S. or China or any other single market. Companies are in so many markets around the world, and their suppliers are in even more markets. So I think what a lot of executives are trying to do right now is really get more transparency for where their supply chains are and think about how they might need to adapt in the future.
Courtney Rickert McCaffrey, EY Global Geostrategy Insights Leader. A lot more coming up here on the big program. Stick with us. This is Bloomberg. All right, let's take a look back at this day in history. May 15th, 2014. That was when National Basketball Association Commissioner Adam Silver, that man there, said the league's owners were unanimously approving the sale of the Milwaukee Bucks to an investment group, led by private equity titans Mark Lasry and Wesley Edens for $550 million. That was a lot of money, particularly for a team that had been bought 30 years earlier for just $18 million, and particularly for a team that at the time had the lowest average NBA attendance and played in the 34th biggest TV market. Yet $550 million, that was a record price. Derided at the time, but in hindsight lauded as one of the best investments ever. A prescient investment as the valuations of sports franchises were about to skyrocket. Just months after the Bucks deal, Steve Ballmer bought the LA Clippers for $2 billion. In 2017, Tillman Fertitta bought the Houston Rockets for $2.2 billion. And those deals, that was followed by Joe Tsai's more than $3 billion purchase of the Brooklyn Nets in 2019 and Matt Ashiba's $4 billion purchase of the Phoenix Suns in 2022. And in March of this year, a consortium led by Bill Chisholm agreed to buy the Boston Celtics for $6.1 billion in what would be the largest U.S. sports takeover ever. And so for that $550 million Bucks sale, Mark Lasry has already turned a tidy profit on that, selling his 25% stake in the club in a 2023 deal that valued the Bucks at $3.5 billion. These eye-popping returns have attracted a horde of investors, and not just the billionaire class that can afford to shell out for an entire team. Relatively less wealthy individuals who want even just a small slice of the action are finding a path to do so. NFL owners just 9 months ago voted to let private equity firms buy stakes in their franchises, a move that's already attracting fresh capital while boosting team valuations. And that trend was on display this morning as Dallas Mavericks minority owner Mark Cuban, along with former Atlanta Falcons CEO Steve Cannon and venture capitalist Rashaun Williams, announced the launch of a $750 million private equity fund designed to take small stakes in U.S. pro sports teams. And I'm pleased to say that one of those investors joins me right now. Rashaun Williams is the founder and CIO of Harbinger Sports Partners. You may also, of course, recognize him as a guest host on Shark Tank. Great to have you here, Rashaun. And a really intriguing deal here. $750, you're still looking to raise that, over the next couple of years and start putting that money to work when?
Yeah, hopefully much sooner, but probably over the next couple of years. We may start putting money to work pretty soon, actually. We have a lot of interest. We have a lot of deal flow, a lot of relationships, and I think teams and leagues are seeing that we bring a lot of value to some of these organizations to help them as they think about transitioning from sports 1.0 to sports 2.0.
Now, I know you can't talk a whole lot about the fundraising here, but when I saw the $750 million, I kind of thought to myself, that kind of seems low. I mean, there's so much demand in this space. I mean, there's just so much money coming in, and I'm wondering, I don't want to get ahead of you here, but I'm wondering if maybe we're going to have you on in 6 months and that number is going to be a lot higher.
Hey, I'm hoping so. Mm-hmm. But as a first-time fund in this space, $750 is a reasonable amount to deploy capital into North American sports franchises. Mm-hmm. But based on the demand that we're seeing, we do think it will probably be a little larger than that. But I think it's a respectable amount to enter the space.
All right, and you already, of course, have been involved with the NFL's Atlanta Falcons. We should point out this fund that you're starting, it's basically agnostic with regards to the sports league. NBA, MLB, NFL, anything else in there?
Yeah, I would say North American sports, and there's such big opportunities in North American sports right now, like you were just talking about. But as these leagues continue to mature, as media rights continue to increase, as they continue to build new stadiums and own all the real estate around the stadium, basically becoming media companies themselves. So sophisticated capital. Investors want folks who have skin in the game, who have been owners and operators to help Sherpa them into this asset class. Mm-hmm. And one of the things that's important from an investor standpoint is non-correlated to the equity market. So as a former venture capitalist and tech guy, I needed to diversify out of tech myself. So I started redeploying my assets into this space about 5 years ago. And I think you're starting to see that trend a lot with family offices and institutions.
With the involvement now of more private capital in this space, now that some of these leagues have loosened the strings on that and you have more investor interest, is that going to create distortions when it comes to valuations? I pointed out the $6.1 billion deal for the Celtics, which would be the biggest deal for a sports franchise ever, at least in North America. But I should point out, there was actually a story earlier today that apparently the San Francisco 49ers are in play at a valuation of more than $8 billion if that were actually to go through.
That's right. That's right. On the cover, it appears that more private equity coming in is going to drive the prices up. But if you peel back the layers, you'll see private equity is not allowed to own majority stakes in most of these leagues, just minority stakes. they're all capped at small percentages that private equity can own. So the majority stakes and the control owners of these teams are still families. They're still individuals. They set the price because they're buying the majority of the team. Private equity comes in as a partner to help provide liquidity to shareholders and owners who've been around for a while, guys that are thinking about succession planning, guys that need cash in order to build new stadiums, and all of the other reasons that people want liquidity when they don't have IPOs or M&A. So private equity becomes a great strategic partner to shareholders and to the ecosystem.
So what are the rules like right now? Because when we talk about, the NFL allowing private equity in, I know on a high level, right, the idea is that you can't really have, more than 6 franchises. Is that as a majority investor or as a minority investor?
Yeah, so we're only talking about minority investors when we're talking about private equity firms. So there are some things called league beneficial owner rules. Every league has different rules, but it used to be uncapped. You can have 50, 60 owners of a professional sports team in North America, 30, 40 years ago. Today, they tend to cap it at, maybe 24 owners. So what happens is as valuations get higher and higher, and people who got in at $200 million and it's worth $3 or $4 billion now, sometimes they want to take some chips off the table. And they can't sell to another owner because that owner is like, hey, I was in at $200 million with you. I'm not going to pay $3 billion. And if they sell to someone else, it trips over those league beneficial owner rules. So private equity comes in and they're largely exempt from those rules. Private equity doesn't count as a limited partner or as an owner, so they can come in and relieve that pressure on the cap table and start helping with liquidity programs for some of these owners that want liquidity.
For your fund, though, I mean, generally you're targeting 5% or less? Is that the general idea in terms of ownership stakes, or is there no?
Yeah.
Yeah, okay.
Yeah, so we're working right in the guidelines that each of the leagues in North America has already set, and it's really small stakes, right? You're talking about 1% to 5% stakes in teams. You'll have multiple private equity firms investing in the same team, but you'll never have, won't say never, it's unlikely that you'll have private equity firms buying a majority of a team and controlling the entire. These are family-run, individually run teams and leagues.
I think it's kind of interesting, too, Rashaun. We've talked a lot about the business of sports and all the investment coming into sports, but often that conversation has been about more, newer sports, if you will. You're talking volleyball, lacrosse, pickleball, things that haven't traditionally been prominent in the U.S. zeitgeist. You're going all in for the granddaddies of U.S. sports here. And I do wonder, though, because, I don't know what to call this. This isn't early stage investing. I don't know if it's late stage. I don't know what it is. It's behemoth investing. And I do wonder if that carries any sort of risk that you've had to sort of talk about.
It absolutely does, and you're spot on. I'll give you the best comparison I can give you in tech. That's the ecosystem I've been in the last decade. So there's early stage, growth stage, and then late stage risk. Early stage, an idea, very little revenue, very little traction, tons of upside, high risk. That stuff takes 10 to 15 years to make money. Only 1 out of 10 make it, right? Think of the early stage sports leagues that you're seeing out there. They're popping up every day. In fact, once we made this announcement on this new fund, I got 50 emails from leagues that I never even heard of. Now, then you have growth stage, and those are teams and leagues that have been around for a while. Maybe they're not profitable yet. They're still growing really fast. They're close to getting to that mature level, like late stage, but they're on their way, right? I would consider WNBA, I would consider Major League Soccer great opportunities. But still, sometimes you have to do a capital call. They have to fund their losses with raising more capital and sometimes diluting shareholders. Now, at the top of the food chain are the late stage or the mature leagues, the basketball, football, baseballs, and they're largely profitable. They very rarely do capital call. There are a few exceptions. They want to win the championship and just start spending a bunch of money. But for the most part, they're stable. They've reserved money in case of a COVID or a player strike, right? And you're not really getting capital calls on them, but stable, expensive assets with a long-term stream of cash flow. Those are the safer late-stage assets.
What makes, in your view, a good investment in a sports franchise or a sports team? Like, what are you looking for? Do they need to be, winners, if you will? You're going to go after the Philadelphia Eagles? Or, can you maybe go we started off talking about Mark Lazary. He bought the Bucks when it was an awful team, let's just say it. And of course, he rode that wave to, a team that, basically became championship contenders.
Right. So there are fundamentals and then there are technicals. So what you see oftentimes with sports, it crosses over to the passion play, and folks were willing to pay whatever price that they need to pay in order to win, the opportunity. Those are more technicals, right? I want this. I'm from Boston. I want to own this team. This is the only basketball team in Boston, right? So the technicals go really strong for local Boston billionaires who want to own that team. But the fundamentals, the most important part of actual of sports teams investing is having the strategy that's appropriate for you as an investor. So again, if you're looking at early stage leagues and teams and only 1 out of 10 make it, it's your job to find 10 to 20 of the fastest growing, best teams and leagues in that space, and then try to get the best price you can on all 10 or 20, knowing only 1 out of 10 make it. If you're only going to do 3 investments and only 1 out of 10 make it, that's not a good strategy. So you're guaranteed to lose money there, right? But for the late stage, when you're looking at the big 3, you're looking at these profitable teams, what you really want to do is look at the management team, you look at the owners, you look at the market that it's in, the percentage of revenue that's coming from media, the percentage that's coming from league and local revenue, and you see what their plan is to grow their revenue in the ways that they can control, which is largely local revenue. Here are the 3 things I would look at if I had to summarize for you. Number 1, are they operating under the assumption that they're just relying on the league for most of their revenue and they're not looking for, local revenue growth opportunities? Number 2, if they are looking at local revenue growth opportunities, building and owning a stadium, renting the stadium out for concerts, whether or not they have pricing power to increase prices, using predictive analytics, there are a bunch of things you can look at to drive more revenue locally. Here in Atlanta, just look at the Battery, right? Look at what the Braves are doing, hotels, office space. This is all flowing through. Chicago Cubs are doing something similar, buying up all the real estate around. There are teams that don't even own their stadium, so they're largely capped. And then number 3, are they really looking at themselves as the future of sports, taking this content that they're creating and monetizing it in additional ways?
All right, really fascinating stuff. We've got to get you back on to get some of that progress. The $750 million private equity fund taking small stakes in U.S. sports teams and being helmed here by quite the trifecta here. Mark Cuban, Steve Cannon, and the guy there on your screen, Rashaun Williams, the founder and CEO of Harbinger Sports Partners. We'll be back in a moment. This is Bloomberg. All right, welcome back. Just a few days ago, the Trump administration proposed cutting about $6 billion from NASA's budget. That sent a lot of shares of companies in the space race lower here on that day. Joining us right now to talk a little bit more about this and whether it will actually come to fruition, let's bring in Lauren Grush. She joins us right now as Bloomberg reporter. Hey, Lauren, when I saw this story last week, it was this idea here that a $6 billion cut in NASA funding is the idea that this is just money that's going to be sort of, shifted to the private sector, or are we really just talking about overall a wholesale drop in the amount of money that we're going to be spending on space programs?
I think, if you look at the cuts that we've seen in the skinny budget, a lot of it is targeted at space science specifically. There seems to be an increase, at least a projected increase, for human spaceflight initiatives. So it seems to be targeted at a certain type of, or certain programs within NASA. So I think you could say that some entities would see a big loss here, while other companies that are more focused on human spaceflight might see more opportunity.
All right, Lauren Grush, Bloomberg News reporter, a closer look here at some of the budget proposals coming out of the White House that could actually affect NASA and overall the investments that we're making in that space race. But that doesn't mean those investments aren't happening. They are happening on the private side, and we do want to continue that conversation about the business of space. Bridgit Mendler is the co-founder and CEO of a company called Northwood. It's a space startup, and it's on a mission to build a data highway between the Terra, Earth here, and space, and just recently raised $30 million. In its latest funding round. Bridgit, great to see you.
How's it going? Good to be speaking with you.
I'm doing well. I'm absolutely fascinated by this business because when we talk about space, there's been so focused over the last few years on all these rockets that Musk and Bezos and other folks are launching into space and the satellites floating around out there. Your approach is a little bit different. You're focusing on what's going down here on Earth and how we communicate with what we're sending up in space. Explain.
Yeah, absolutely. ultimately, at Northwood, we want to put space to work for people on Earth. And our hot take is that the big problem to solve doesn't start in space. It actually starts on the ground. And so that's why we're building a network of antennas on Earth that connects to space, and it enhances what space missions are capable of. I think folks, don't really necessarily realize how integrated space is into our everyday lives. When you're swiping a credit card, when you're turning on a light switch, you're connecting to time signals that are being sent from space to keep the grid on and allow financial systems to run. And so for us at Northwood, we want to protect those critical services, but we also think that that's just the beginning of the story of what space can do for people on Earth. So we're building a network of ground stations that satellite businesses can use as a foundation to do more ambitious things.
So forgive me for the dumb question, but why doesn't this already exist, these ground antennas, or do they?
They do exist, but they have a limited level of connectivity. There's just not a large enough number of them, which limits the kind of services that you can provide. For example, satellite imagery has actually become so good that you can give actionable information to firefighters to help put out wildfires. So it's not actually the tech that's on the satellites that limits the potential for that, but it's the fact that they can't reliably contact the ground within a time period that's relevant enough, like 15 minutes, in order to actually have those images taken and deployed to the firefighters on the ground. So if they were able to have more capacity and more connectivity on Earth, then that changes what those missions are capable of. And it also opens up a whole lot of other mission possibilities as well.
With regard to what you're doing, as well as some of your competitors, or as well as other folks adjacent to you in this space, how much of this is just being driven by private companies like yourselves, and more importantly, private money? Is there government involvement? Is there government money actually also helping to sort of push these efforts forward?
Yeah, I mean, the government has very similar problems. They're also dramatically under capacity. And so one of the problem areas that we're focused on in our early days, we ultimately are building a network that aims to serve the majority of satellite use cases. But initially, we're focused on a more narrow slice called command and control, which I describe as kind of like the remote control of satellite operations, where, a satellite's like the remote control car that requires instructions from a remote control that's back on Earth. That's the antennas that we're building. And so that is the case across a wide variety of missions, both commercial and government. And so we are building a product that can support 10 simultaneous links at once, and it can go across multiple orbits. So you compare that to antennas today that can only contact one satellite at a time from a single orbit. And so we are not just building one of those systems, we're building dozens. And that is a scale of capacity that's similar to what both commercial and government networks have been able to accomplish over decades. And so we're seeing both government and commercial appetite for more of those kinds of services.
With regard to controlling the antennas and more importantly, I guess, getting the data from them or pushing whatever data you need out of them here, is that done from like a centralized location, or do you have to actually be in close proximity to where these antennas are?
So that's controlled by the customer. The customer controls being able to direct their satellite. We're just a pipe to send the data.
So when we talk about the potential growth for your business, and there are a couple other competitors in this space as well, I mean, what is, I guess, the addressable market, for lack of a better phrase, that you see out there?
The addressable market is the space industry. The solution that we're building is a common set of infrastructure that's required across the entire industry. So I like to think of infrastructure from space kind of in three core pillars. There's the things that you put up into space, which are satellites. There's the way that you get them up into space, which is launch. And then there's what you can actually do with them once they're up in space. And if you don't have a ground network, then you just have a bunch of expensive metal circling the Earth up in space. And so it's the ground network is that core common piece of infrastructure that sits across the entire space industry. So the market, you could say, is quite large.
And are you already planning a next funding round, or is it too early to talk about that?
We're focused on building. We have big ambitions, as you can imagine, aiming to build a global network. We're planning to actually be multinational operations this year. So we're focused on building and deploying the technology. I think there's been an overwhelming response of interest in what we're building, and so that's the next thing for us to prove is, can we translate that into an actual operational capability? And looking forward to getting some tech out in the field.
All right, and we're looking forward to talking to you again as we sort of chart your progress of that company. Bridgit, really fascinating stuff. Bridgit Mendler is the co-founder and CEO of Northwood, building these ground antennas to communicate with the satellites out there in space. We do want to get to some breaking news crossing the wire on Live Nation. Those shares moving lower in the after-hour trade after we're learning that the U.S. Department of Justice is conducting a criminal antitrust probe into how companies responded to mass concert cancellations at the onset of the pandemic. The focus right now is on Live Nation and AEG Presents and whether they illegally colluded on refund policies. This is according to people familiar with the matter that our Bloomberg reporters have spoken to. We have reached out to the companies for a comment, and we are still awaiting to hear from them. We'll be back in a moment. This is Bloomberg. All right, here are a few things out there that could move markets over the next 24 hours. That includes economic forecasts, those spring economic forecasts out of the European Commission. A closer look here at the big trading block over there in Europe. Meanwhile, back here in the United States, 8:30 a.m. Eastern time, we are going to get a read on housing starts, which of course contracted in March. They're expected to have continued their growth or resumed growth back in April. We're also going to get a read on University of Michigan sentiment numbers that have been falling for 4 straight months. That's actually expected to show a bit of a rebound as well. And all eyes still on the President of the United States as he wraps up his trip to the Middle East. That does it for the close. Stick around. Balance of Power is up next.